Have you been saving for retirement your entire life and you think that tax strategies are only for business and real estate owners? Well, that thinking could be costing you big time. In today's video, I'm going to be revealing 3 big mistakes that a lot of retirees make and how you can avoid them for your own retirement. The first big mistake I see all the time is people aren't taking advantage of tax harvesting. Now, a lot of you may be asking, Daniel, what's tax harvesting? Tax harvesting is a strategy that takes a look at different rates for capital gains, specifically long-term capital gains, because those are going to be cheaper than ordinary income, with some rates being as low as 0% depending on your other income. To illustrate an example of this, let's take a look at an example of a client who wants to receive $120,000 a year of income in their retirement. And let's say they're a typical couple who has a traditional IRA and a large brokerage account with lots of long-term capital gains. Well, the first thing they might do is they might take a look at taking approximately $30,000 of taxable income out of the IRA. That's going to fall into their standard deduction, or in other words, their 0% income tax bracket. Then they could take an approximately another additional $89,000 from their deferred brokerage account, which would be after tax and ordinarily long-term capital gains, but they would fall in the 0% capital gains rate. So they could arrive at their $120,000 from tax-deferred accounts with taxable gains and pay 0 income tax. This is a good example of how they could be using tax harvesting instead of just taking large withdrawals from taxable accounts. Mistake number 2, make sure you avoid the Social Security tax bomb. The Social Security tax bomb is a concept that involves provisional income, which is related to how Social Security is taxed. In other words, Social Security has its own form of tax brackets, and you really want to understand those to make sure you're not overpaying any unnecessary tax in retirement. The amount of Social Security that's included in your taxes is a sliding scale based on your provisional income, and it can include all the way up to 85% of your Social Security benefit. This creates a sliding scale that impacts your tax liability. As your income increases in retirement, not only does your income become more taxable, but it also pulls in more of your Social Security income to become taxable. This is what results in the Social Security tax bomb: higher taxable brackets and more taxable income from your Social Security. The impact of the Social Security tax bomb depends on your individual circumstances, but just a quick example to illustrate this: every extra dollar you get from Social Security in a 12% bracket, for some people can actually result in their effective income tax going up to above 22%. Mistake number 3, under or over converting IRA balances to Roth. One of the most common questions I get is, should I be doing a Roth conversion? And then the follow-up question is, well, how much should I convert? I always point back to the client's CPA, but under converting or over converting can seriously lead to costly tax mistakes in retirement. Many people I sit down with save the bulk of their retirement savings in pre-tax accounts, never taking into consideration that one day between ages 73 and 75, they'll be in forced distributions that can actually significantly increase their tax liability for the rest of their life. Some individuals that are aware of Roth conversions will sometimes over-convert for fear of these distributions or for fear of future higher tax rates. Over-converting can be a very costly mistake and oftentimes lead to you paying way higher tax than if you had just done nothing at all. Let me give you an example of this so you can see the difference. Rick and Stacy are sitting down with their CPA to analyze their taxable situation to make sure that they're maximizing their income from their 401k and Roth IRA in retirement. The analysis involves looking at their total taxable income projected to age 95, and this is going to include their Social Security, their pensions, their 401k distributions, and brokerage account distributions. And what they're going to be looking for is periods of time when they're going to be in the lowest taxable thresholds. If Rick and Stacy don't do any Roth conversions, they end up paying higher income tax later on in retirement when things like Social Security, pensions, and those required minimum distributions kick in their 70s. To avoid under-converting, the CPA recommends that they actually take distributions from their pre-tax 401k and shift it to the Roth before extra income kicks in, pushing them into a higher tax bracket. This will protect their income by allowing them to pay income tax at a lower rate earlier on in their retirement before that extra income kicks in. However, the risk of over-converting is very serious because it could cause them to pay tax on money that they're going to get rid of and reduce their portfolio forever, and they may not live long enough to make those gains back up. The optimal conversion strategy involves the CPA taking a look at their taxes on an annual basis. They're going to be looking at things like future higher tax rates, their returns, their income, and their spending to make sure they're optimizing on an annual basis so they're not over or under converting their traditional 401ks and IRAs over to Roth. These big mistakes when you're under converting or over converting can result in the loss of tremendous opportunity costs, which for some people can be hundreds of thousands of dollars over their lifetime. So going back to that first mistake we talked about involving tax harvesting, one of the key differences is to understand your tax brackets and understand how your income is taxed in those brackets, looking at the difference between ordinary income and long-term capital gains. Now, I'm not a CPA who gives tax advice, but at Nations First Financial, we work with incredible teams of CPAs and tax attorneys that can actually sit down and strategize with you on an annual basis to make sure that you're optimizing your tax situation. If you're interested in seeing how we help people in retirement at Nations First Financial to step into the abundance mindset and maximize retirement income, click the link down below. You can book time with me and my team, and we can walk through that process together. Hey everyone, if you enjoyed this video and you want more information about retirement, be sure to check out my new book, Buy Back Your Life, How to Stop Worrying About Money and Start Living in Retirement. If you want a copy of this book absolutely for free, call my office with this phone number below. Talk to the girls at the front desk. You don't have to provide any information. We just need your name and address, and they'll mail you out your copy today.